Good afternoon, everybody. I am Paula Hune with Funding America Mortgage, and welcome to the webinar 2 of Planning for Success. What we are going to learn about today is we're going to learn Mortgage 101 for Realtors. So Mortgage 101 for Realtors is designed to help you, the agent, become a little bit more adept in what goes on with the mortgage so you can prepare for some of those unexpected things. And so you can be a little bit more knowledgeable. It'll also help you when you're on the listing side, be able to ask the right questions when vetting different offers. So, as a mortgage loan officer, I love sharing my expertise on mortgages. I'm going to share them with you today. You guys play a crucial role in guiding homeowners through the process. So this is important that you learn about this as well. All right. So what are the benefits of learning about mortgages? Okay. Well, it's going to enhance your client service. So understanding mortgages, the process at least, it's going to help you assist your clients. So when you are talking to someone who just got pre-approved, you can discuss in a more knowledgeable way how to best find the right program, how to find the best house. Okay, because every house is going to be a little bit different. And so you're going to be able to be the expert to show them, the houses that are going to fit their budget. Okay. Also, collaborating with your mortgage professionals are going to have a stronger relationship and stronger partnerships. I love building strong partnerships with my realtor referral partners because if I educate them and if I help them understand what's going on, they have more ammunition to, excuse me, to be a better realtor. Okay, and also gives you a competitive advantage because if you know more about the mortgage world and mortgage business, you can accept more offers because you know what is going to be a good loan, what's not. You can also know what questions to ask a loan officer and mortgage professional to help pick the best option for your seller or to help guide them with picking the best option for them. Okay, so the next step is, what you got to do is understand the process. Okay, it's more than just, okay, you get pre-approved and now you get a loan. Okay, and this kind of flow chart simplifies it even more. Okay, but I wanted to keep it easy so you weren't inundated with information. So the very first thing we have to do is a pre-approval. Okay, buyers work with a lender to get pre-approved. What we do during that pre-approval is, at least what I do, I'm trying to gather as much documentation up front as I can. Okay, I want to see their income, I want to see their assets, I want to get to know them. I want to also find out why they're doing what they're doing. What's their motivation? What are they looking for? I've been doing it that way. I get a full idea of the whole file and can make better I can make better opportunities for the client by knowing what their end goals are. Okay, now when I pre-approve, I usually will pre-approve to the maximum and say, okay, this is your absolute max, can't go any higher than that. And then we talk it backwards, right? So the pre-approval letter I give may or may not be their absolute maximum, but you got to remember that sometimes these buyers, they don't want to spend their maximum. They want to be financially responsible. And so they're going to look for something a little bit lower. Okay. Sometimes we have to go to the max. But it's something that I communicate on all my pre-approvals. Now, the difference between a pre-qualification and a pre-approval, if you don't know, pre-qualification is really just, I take the buyer's word for it. They tell me how much they make and I take their word for it. They tell me what their credit score is. I take their word for it. A pre-approval is a little bit more detailed. So it can be as detailed as I got all their information, I did an income calculation and ran it through an automated underwriting system. It could be even more in depth by actually going to one of my many lenders and having them actually have an underwriter review the file before they go shopping. Now, as you can imagine, the last way is probably going to make your buyer the strongest. But remember, that doesn't necessarily mean that they're going to be, sorry, it doesn't necessarily mean it's going to be quick. Okay, I have to make sure that I get all the documentation from the borrower. I have to submit it. We have to give the underwriter time to review it. And when there's not a contract attached to it, it can, it's not top priority for underwriters to review because they're trying to get active deals closed into the closing table. So there could be a 3 to 4 day waiting period for an actual underwritten pre-approval. But my question would be, what would you rather have? A pre-approved client that actually has already undergone the underwriting process, or someone that I just kind of went, yeah, looks good, might be able to do that. I think all of us would agree we want the pre-approved, pre-underwritten borrower. They're stronger. It's easier to know where our limits are and what our plan is going to be. But just know that that's going to take longer. So if you have a borrower who, let's say, showed up to an open house and they want to put an offer in that day on that house, it's not going to be a pre-approval. Okay. It's just, there's not enough time. It could be a lender pre-approval again, which is where I look through and do the automated underwrite, but I pull credit and all that other good stuff. But that's not going to be a pre-underwritten and pre-approval. You can't do that same day. Okay. So once the client gets pre-approved, then they're going to go out with you and you're going to ask them, okay, what are your wants? What are your needs? A professional like myself will offer to make comparisons every time you take them out to see a couple different houses so they can see which houses, what payment goes with which home, what the out-of-pocket cost would be. And it'll help your buyers make an educated decision on what kind of offer they want to make on the home. For example, home A might be $200 over their budget, but it has literally everything they need and let's say 70% of their wants, right? House B might have half of what they need or 80% of what they need, a couple wants, and is $200 cheaper than their budget. Well, this gives your client, your buyer, the power to decide, you know what? It's worth the extra 200 to buy a home that has everything we're looking for, right? As opposed to you not even showing that house and saying, oh, what's going to be over your budget. So keep that in mind as we're shopping, right? So once you shop and they find the house and the offer gets accepted, the next step in the mortgage process is we go under application. So once we get your contract, the agreement of sale, now we're going to submit the loan application. That's where we disclose the loan estimate and other different disclosures that the borrower has to sign. These are your initial documents. Okay, so the loan estimate, that's going to tell the borrower, worst case scenario, this is how much you're going to need out of pocket. Okay, so you know how many times you've had a client who said, oh, I don't know how much I'm going to need for closing. And you're like, well, did you talk to your lender, right? You can now know, you can say, oh, well, it was on your loan estimate that your lender sent you in the beginning. Okay, lenders should be going over the loan estimates with their clients, so at least calling them and letting them know what it is. And reviewing this way, when they review the costs, they're not surprised when they need an extra $100 on an appraisal fee because the appraiser has to go back out. That's already going to be in the documentation that we sent in the beginning. Okay. Yeah, it's not going to be 100% correct, but it's going to be very, very close. And lenders are very good at making sure that they overestimate what the borrower needs. No one wants oh no, now you got to bring more money to the table type of scenario. Okay. So that's part of the application. That's what starts at the application. The application stops there. Okay. Until the borrower signs their disclosures. Okay. So now this is going into something called TRID, which TRID is regulations and rules regarding timing of giving different disclosures and documents to a borrower. We cannot move the file into underwriting unless the buyer has signed all of their disclosures. So it's really important that we're making sure that the buyer is doing that. It's a rare occasion that happens where they just didn't know or they didn't realize or they don't speak up or say anything. But it is maybe a question that I would ask for a follow-up. If I was an agent saying, hey, you received your loan estimate, you reviewed it, you signed it, correct? And if they say, yes, I did, then, everything's kind of on the up and up. So once all the disclosures are signed, and once we have all the initial documents, which we're going to go over in a little bit, then the process goes into underwriting. Now, what the heck is an underwriter, right? Aren't I supposed to be the one who qualifies the borrower? That is correct. An underwriter is someone who's going to make sure that the file that I'm creating jives with all the guidelines and all of the requirements of that loan. Okay, so it's like trust but verify, right? The underwriter is the verifier of all the information of your client. So they're going to verify that the way the loan is structured is a good loan, that everything makes sense and it qualifies for the programs we're looking at. Okay, they're not bad people. And I know a lot of loan officers who like to blame the underwriter for everything, right? Everything's the underwriter's fault. It's not always the underwriter's fault. Okay, they're trying to do the best they can to make sure that things go the way they're supposed to. Now, again, a lot of times underwriters get limited because they're only going by what they see in the file. So if there's something, a document missing, or if it's something just doesn't quite make sense, an underwriter is going to what we call condition for those things to make it make sense. Okay, and they're in their full right to do that. So the initial underwrite, the underwriter is going to look at everything, say, okay, verified income, check. Verified assets, check. Verify who they say they are, check. Okay. And then it all looks really good, and maybe we only need a few different documents to make the file whole, then it's going to move to commitment. Okay, your commitment is your conditional approval. That's going to say, okay, great, we're looking good, we're moving forward. The only thing we need left, maybe they still need to get the appraisal back. Maybe we're waiting on title. Maybe they need to show they have a little bit more assets. I've never seen that hold up a file from getting committed because maybe they're waiting for their paycheck to come in. Maybe they're waiting for a gift from a family member. So there could be some time for that, right? But we want to know, okay, well, what's still left that we have to do on the file? Sometimes it could be third-party things. Sometimes they need to verify the income or with a verbal verification of employment. Sometimes they need to update the credit. Sometimes they need a credit supplement. These aren't things the borrower necessarily needs to do, but it's things we're going to be working on and trying to get them done. So what's important as a listing agent and a buyer's agent, when you get the commitment, read it. Okay, read it. Many realtors don't read the commitments. I know, but many do not read the commitments. And I think that you do yourself a disservice when you don't read it. It may seem like, oh my gosh, you might have 23 conditions on that commitment, and that might seem really scary. But most of the time, if you have that many, a lot of them are all the same. They're just worded a little differently. Or if you get something that's overwhelming, you can always just email your lender, say, hey, this looks like a lot. Is it really this bad? Can you break it down for me on what I need to do or what the buyer needs to do? Or just give me the main pieces here. And they'll be able to kind of piece it all together, because a lot of times on those commitments, there's conditions that aren't even that aren't done right away, or they're not even the buyer's responsibility. Okay. On the flip side of that, you could read something, and especially if you're on the listing side, you want to read that commitment and go, well, wait a minute, it's saying we still need to verify their overtime with a written verification of employment. How long is that going to take to get? When, what's the ETA? You can ask more educated questions by reading that commitment and saying, wait, how will this impact? What's the likelihood? What if we don't get this document? What's going to happen? What's the likelihood of getting the document? You might get a little pushback, but you have a right, if you get the commitment and it's on there and you want to know more details about the condition, I would 100% ask the loan officer. They should be able to explain it to you very quickly and clearly. Then once you get the commitment and we get everything that's listed on that commitment cleared from the underwriter, they get all the data, they're verifying the data. Now they're saying, great, now we're cleared to close. Everything on this file meets the parameters, meets the guidelines. You guys can now schedule closing. This is really important, and I think a lot of agents don't realize this. You can't schedule, you shouldn't schedule a closing until you have that official cleared to close. Okay, in a perfect world, we'd get a clear to close 2 to 3 weeks ahead of time. In a very perfect world, we don't live in a perfect world, and there are going to be times that that clear to close isn't until like the 11th hour. Okay, even though on the contract it's saying closing date is this date, if you start to feel that okay, we're not going to close on that date, you need to extend it. You need to find out from the lender approximately how many more days they might need, where is it at, what's going on, and extend it. I definitely would not schedule anything until you have that clear to close. Okay, that's part of the reason why I do strive to get my clear to close, and I try to time my loans as much as possible so that we're getting that clear to close 7 days before settlement. That's always the goal. It doesn't always work out that way. I wish it did. Trust me, it's less stressful, but that's what we try to do. Okay. Another thing, if you want to make sure that you're not going to have problems, is, maybe you set your closing date 45 days out, 60 days out. Clearly you're not always going to have that opportunity to do so. Sometimes you really do have to close in 30 days, whether if it's your buyer and you're up against a cash offer, or, you're a listing agent and your seller has to be out by a certain day, or it's dependent on other files, that will all go into when we have to close. But just know the shorter amount of time that you give a lender, the more stressful it's going to be during the process, because every minute of that counts. Okay. So if you want more breathing room, it's always best. But again, you're not always going to have the opportunity to give breathing room. So just realize we do recognize that. We always prefer a lot of time, but that doesn't always mean we're going to get a lot of time. And we get that. And we always do whatever we can to meet those closing dates. But sometimes it just doesn't happen. Okay. So once you're clear to close, then you can schedule it with title, the seller, the buyers, everyone goes. And then we all go to closing. It's probably my favorite part of the process, of course. I love going to closings as much as possible. I get to see the agents. I get to see the buyer. Remember, we don't get to see the buyer every day. You guys do. So it's a really, really nice treat to go there, go over the final disclosures one more time, one last time, go over everything. They sign it. Everyone goes, yay, we take pictures. So that's the mortgage process in a nutshell. Okay. Now, things like the appraisal, they're going to appear around here. Okay. In between application and underwriting, the appraisal is going to get ordered. Okay. Ideally, we like it to come back before the underwriting does their initial review, but sometimes it's kind of in the middle. Okay. So it might be a little bit after the commitment. So you might get an updated commitment that says that they reviewed the appraisal, but it gets ordered around here and it comes back usually around this part. Okay, same thing with title. You guys order the title in the beginning. We usually don't get it until, in around here between 3 and 5, someplace between there. Those are those things that are third party that we really don't have a ton of control over. All righty, so moving on. So I want to go over some of the documentation that your buyers are going to need, because I've been asked several times by realtors, well, what do you want my buyer to give? What should they have? Well, you can always say, oh, well, we need to verify income, assets, who they are, right? So identification, they need to have some sort of driver's license, passport, government issued ID. Okay, if they don't have that, talk to me. Let's find out what we can get, okay? Income verification. This can change depending on how that person gets paid. But typically what we're asking for are pay stubs, W-2s, tax returns, and any employment records, right? So if they're a 1099, guess what I want? I want the 1099 and the tax records. If they get Social Security, okay, well, now I need to get the proof that they received Social Security. Okay, we do that in several different ways. If they receive dividends, I need to see the proof that they get the dividends, things like that. So income verification doesn't always mean just simply pay stubs. There's a lot that goes into income, especially if you have hourly employees, right? Not only do I just want the most recent pay stubs, now I'm going to want pay stubs and the end of year pay stubs for the last 2 years. Why in the world would I need that? Well, their W-2 is going to lump all their income into one number. Okay, that's on their W-2. That's fine. We will need that. That shows that they get paid, right? The end of year pay stub, however, is going to show how that total is broken down. So when you're talking about things like overtime and commissions and bonuses, we need to average them out. If we don't know what that number was for the previous year, it's harder for us to make that determination. So that's why, when we have these variable incomes, we're going to want more documents. It's inherent. If you're a self-employed business person, we start with your self-employed tax returns, your business tax returns. Well, depending on what they say, we might need additional documentation, and if you're self-employed, the other thing is you don't get a pay stub. So how do you prove that the self-employed employee is on track to make the same money? Well, we get something called a profit and loss statement, a P&L statement. Finally, what we're looking at is we're going to be looking at your assets, okay, a buyer's assets. We're going to look at, see if they have the money that they have. Now, again, this kind of can go either way. This could be, if you actually have a buyer who is 6 months out from looking, they may not have the assets yet. Okay, they may not have the money saved, and we're doing the pre-qualification and pre-approval so they can see how much money they need to make. That's very, very different than the buyer who went to your open house is like, I want to buy your home. Well, if you want to buy this home, I hope you already have that money saved. That just makes the process go smoother. But that's part of what I do as a loan officer is have that discussion. How soon will it take you to save this money? How much time do we have? Which is going to help you build your timeline on your contract. Okay. Credit history. Now, this is also really important. So I pull my credits on all my clients. This way, not only do we get to see the scores, because it's more than just the scores. It's actually what's on someone's credit. I've pulled credit scores where people are in like close to 800 credit scores, and I can't get them the loan because sure, they're at 800 credit score, but their history is too short. Or I remember way back when, in the beginning, when I was doing this, I had a client, great credit score. They rebuild their credit after a Chapter 13 or after a Chapter 7 bankruptcy. And it was only, I think, 2 years old. Can a loan, right? So there's different hard stops. So the credit history is actually more important than the credit scores. And I'm going to go into like what loans require which types of credit and things like that in a little bit. But I get this all the time where people are like, but my score. It's not just a score, we have to look at a file as a whole. Okay, so we're looking at someone's story. And in that story, we're looking at the verification. We're looking at the source material for the story. Okay. And, we have to build a story around the data that we have. And sometimes, again, the buyer can have a really good score or have a score that qualifies, but it's the history that doesn't qualify. Okay. And sometimes it's harder to fix. The one thing I really can't fix is income. You make what you make. Unless someone goes and quits their job and goes get a better job, I can't help that. Right. But I can help them if, let's say, they don't have enough to save. Okay. Well, let's look into grants and whatnot and down payment assistance loans. That won't work. Okay, well, how much do you have to save and how long will it take you to save this? Is there a gift you can get from a family member? Can we get seller concession? Things like that. Like I can fix that, right? Like I can come up with a plan. Credit history. I can even come up with a plan for your credit history, right? I see what's on there. I can say, okay, we got to do X, Y, and Z. We need to wait. We need to do this. We need to do that. Pay this down, whatever it is, right? We create this plan. But when it comes to income, it's a little bit harder to tell someone, well, you just got to get a better job. That's easier said than done. Maybe it's adding a co-signer, maybe it's adding a co-borrower or whatever. But that's always the thing I really can't do. That's the only thing I really can't do much about as a lender. All right, so this is the documents that we're looking at. What you all came here for, okay? We're going to go over some of our loan programs. So we have FHA, USDA, VA. These are our what's considered government-backed loans. Okay, so FHA is probably the most popular. It's insured by Federal Housing Administration. So again, it does not stand for first-time home buyer loan. It is not it's not just for first-time home buyers. Federal Housing Administration. That's what FHA stands for. It is under HUD. Okay, so if you hear of HUD homes, that's why it's a FHA loan that someone couldn't pay for. Okay, you can go down as low as 500 on the credit. Okay, certain parameters apply, but they will allow a loan to go through at a 500 credit score. Down payment is going to be as low as 3.5%. Again, that's not on all situations, but it can be as low as 3.5%. You can get up to 6% in seller paid closing costs, okay, to help with down payment money, or not to help with down payment money, but to help with the cost of buying a house. You can do something called manual underwriting, okay? And what that means is when a client meets the needs, when the client is a good client, like when we really think that they're a strong buyer, maybe they just have a weak credit score, or maybe just don't have a lot saved, or their debt to income is really high. We can do something called a manual underwrite, where we're looking at the compensating factors. Now it's going to be more paperwork, and it's going to be a little bit harder, and it's not a guarantee, but it's definitely it's definitely something that I've used in the past to get someone to get to closing. You also have a cool renovation feature. It's called 203K loans. That's a whole other training that I'll do. But 203K loans, one of my favorite loans in the world. Those help people either refinance or purchase a home and finance the cost of doing the renovations. There's a lot to them, so that's definitely another training. But just know that it's there. Okay, USDA loans. The USDA loans are backed by the U.S. Department of Agriculture. It's designed for low to moderate income buyers in rural areas. Okay, so these are like farm areas. Um, as little as 0% down. You don't have to put 0% down, but you can. You can get up to 6% in seller paid closing costs. Now, these have a very strict debt to income requirement. You're not going to be approved as high as you would on an FHA loan, on a USDA loan, because they have to offset the nobody on payment somehow, right? So they limit the debt to income ratio on that. And the home needs to be in one of their designated areas. Now, if you have a person who's purchasing a home, or if you're listing a home and you know it's in a USDA area, if you're not sure, you can just simply call me. I'll verify if it's in a USDA area or not. You can market this to be as down payment as low as 0%, right? It's in a USDA area. I will say though, is also a great tool for someone who is qualified conventionally, but maybe their buying power would be a little bit more if they didn't need the mortgage insurance, because with the USDA loan, you do have a guaranteed fee, but it's nominally, so it's a lot lower than what you would find on a conventional mortgage with mortgage insurance. Okay. Same thing with VA loans. The next loan we're going to talk about, VA. VA is guaranteed by the U.S. Department of Veterans Affairs. It's available to active duty military, veterans, and their families. It's a 0% loan. There's actually no credit requirements. Now, different lenders will have their overlays, which are like their own requirements for approval, but VA does not have a minimum credit score. They also do not have a maximum debt to income requirement. What they do have is something called a residual income test. So only a small portion of the borrower's income must be left over after taking into account the mortgage payment and other fees such as childcare and things like that, to make sure there's still a little bit of income left. Okay, not wipe them out every single month. And you can ask for up to 4% in seller paid closing costs. Okay. And again, Why would someone choose a VA loan over conventional? Well, again, there's no mortgage insurance. So even if someone's putting 3% down or 5% or 10%, this still could be and they're a veteran. This could be a more viable option than going conventional. Okay, so loans do not necessarily mean they're bad. These aren't necessarily bad loans. I think it's important that everyone understands that because they get a bad reputation and they really shouldn't, because these are the loans that help people get into houses. Okay. Some of the benefits, again, you're looking at accessible financing, competitive rates, and flexibility. We already talked about that. Conventional loans. Okay, conventional conforming loans. What's the difference? Conventional conforming loans are what we call Fannie Mae, Freddie Mac. Okay, so you may have heard Fannie Mae, you may have heard Freddie Mac. These are just the two largest companies that purchase conventional loans. Okay, the minimum credit score on a conventional loan, if you didn't know, is 620. Yes, I have done conventional loans with the credit score as low as 620. There's special programs that give low to moderate income families better pricing, which can make a home more affordable. There have been times when I've had a client and we start off with FHA and then determine with the right property that they're better off going with a conventional loan, and we can do the loan that way. Your minimum down payment, if you're a first-time home buyer, can be as low as 3% down. You do have loan limits. It varies by location, but again, these are things that we look up. Typically, the loan limits are higher than government loans. So if you have a buyer who's purchasing in an area, let's say if you're in New Jersey, it's a little bit more north. Okay. The FHA loan limit is still the same as if they're buying down here. So if you're buying a house where normally they're priced at like 500, 600,000, they may not be able to do an FHA loan with just the minimum down payment because we have different loan limits. Okay. That could affect whether or not they're buying the house or not. And the appraisal process is pretty simple. It's the same thing as FHA or any of your government loans. But one of the bigger differences is on a conventional loan, they're not looking at as many safety issues as, say, one of your government loans would be. Okay. And also with the government loan, I mean, technically with any loan, if the appraisal comes in lower, you're not required to negotiate. If it comes in lower than the sale price, you don't have to continue to purchase it. With a conventional loan, if you have the assets to cover up the difference, yeah, you're buying the house. Okay, so that's important to know, and it's something that a lot of people don't realize. So on a conventional loan, if the appraisal comes in short and your buyer has the assets to cover it, you're buying it. They can't deny it for that. Okay. Next, created this really cool cheat sheet for sellers. Okay. So when you're looking at your different offers, these are some things that I think sellers should be thinking about. Okay, so again, you should never, ever tell a seller not to pick an offer just because it's a government loan. Okay, that's actually redlining. You cannot do that. You really shouldn't do it. Or not even just, it's just it's like goes into like anti-steering and things like that. Okay, so FHA loans, what sellers need to know is they may need to make minor repairs to meet FHA guidelines. So if the FHA appraiser goes out, and again, they have a more broader sense of what's a safety issue. They see chip paint, they're going to make you scrape and paint it. If they see steps without a railing, they might make you put a railing on. If anything attached to the house is falling apart, like a deck, if it's not safe, they may make it get repaired. If a shed is dilapidating and falling apart, they may make it be torn down or get fixed or whatever. So they have a broader sense of the safety issues. All right. There's also an FHA anti-flipping rule. So A seller cannot sell it to a buyer using an FHA loan if they've purchased the home less than 90 days. So if the buyer is putting an offer on a home that the title was just transferred less than 90 days, they cannot use an FHA loan. They have to go conventional, or they have to wait till day 91 to sign that contract. Okay. There's other things involved in that too. On the 91st day, let's say you do go under contract. Keep in mind now you need, if the purchase price is 100% or more than what they originally purchased it for, you're going to need two appraisals to verify the value. Okay. The appraisal on an FHA loan, it does stay with the home for 6 months for any other FHA or government deal if the original deal falls through. So again, it's not the best thing. No one ever wants a deal to fall through. They never plan for a deal to fall through. But if it does, that appraisal can stay with the home for 6 months. So whenever that value came in, whatever those repairs were, that's going to go on to the next buyer if they're trying to buy it with an FHA loan. That can work in your advantage too. If the appraisal came in fine and let's say the buyer just didn't qualify for whatever reason in the end, you can easily accept a new FHA deal and they just need to transfer everything, and that might go faster. Okay. It's not guaranteed to go faster, but at least now you don't have to wait for the appraisal. You just have to wait for the appraisal to be transferred, which again isn't always as easy as you would think. USDA loans, if you're accepting a USDA offer, no down payments required. That doesn't mean the borrower's not creditworthy. Okay, like I said, USDA has very stringent requirements when it comes to their debt to income ratio and their credit filing as well. So yes, they're buying it because they don't want to put any money down, because who wouldn't want that opportunity? Okay. And it's actually probably a more stable loan than some of the conventional loans. So don't dismiss it just because it's a government loan. Same thing with VA loans. This hurts a lot. There are some sellers out there, they don't want to do VA because again, it's a 0 down payment loan. And they feel like that means the person doesn't have money. Doesn't matter. It doesn't matter. They're taking advantage of their right, and their benefit from serving our country. Okay. It does not mean they're not creditworthy. It does not mean they're not good buyers. It does not mean they couldn't go conventional if they wanted to. It's just, again, if I'm offering a loan at 0% interest or 0% down, and there's no mortgage insurance compared to someone who's putting 5% down and they have a huge mortgage insurance bill, I'm going to pick the VA loan, right? It's cheaper. If the out-of-pocket cost and the total monthly payment is cheaper for the buyer, that's the way they want to go, and as a lender, I owe it to them to allow them that confidence to be financially responsible. Okay. They did temporarily update the guideline that the seller is allowed to pay for real estate commissions through a credit. Okay. And just in case you didn't know, a seller does have to pay for the wood destroying insect report. Okay. And yes, that means if there needs to be any remedy to that, that also has to get cleared. So it should probably put on there a clear wood destroying insect report. Okay. Conventional loan, that does not mean a better buyer. What do I mean by that? Well, there's two types of conventional loans. There's conforming conventional and non-conforming conventional loans. Your non-conforming conventional loans are your non-QM loans. I'm sure you heard about. I'm sure you've heard about things like DS debt service loans, which are great for investors because we're not qualifying the income. We're qualifying you on, does the amount of rent you can get cover the mortgage payment or cover it and then some. Some of your I-10 buyers. So if you have a buyer who doesn't have a social, but they have an I-10 number, which is a tax ID number, sometimes they have to use special programs. Well, that's a non-conforming conventional loan. Self-employed borrower who wants little or no documentation. It's a non-conforming loan. There's many other opportunities out there and other options for buyers than just your regular conforming conventional and government loans that can benefit them. So when you're receiving a pre-approval letter, you should probably ask if it's a conventional, saying, oh, what kind of conventional loan is it, Fannie Mae or Freddie Mac? Okay, and have them answer. Because if it's not a Fannie Mae or Freddie Mac, maybe that will go into your decision, the seller's decision on if they're going to pick it or not. Because I'm going to be honest, on any of these loans, anything can happen that can cause the deal to fall through. Okay, I don't mean to be like the Debbie Downer of lending. There's plenty of things that if you do it right, you won't have deals fall through. But things happen. It's real estate. Things happen. And just because it's conventional doesn't mean it's guaranteed. Just because it's VA doesn't mean it's guaranteed. There is no guarantee in this. Okay. But if everyone does their due diligence, they can feel confident with different things. Okay. And that's why I wanted to have this training today, to give you that confidence that when you're looking at these offers and you're looking at if you're looking at a buyer, let's say you have a buyer and they're looking to get pre-approved, that if they say something to you, you kind of have a little bit more back understanding of what it means and why we're doing what we're doing. I can promise you, every single loan officer, every single underwriter, every company wants to close deals. Okay. No one's ever purposely giving anyone a hard time. They're just trying to close the deal the best way they knew how. Okay. Be that, take that for what it's worth. They're trying to close it the best they know how. And they're trying to put it together with what they're working with. All right. So with that, okay, that concludes the Mortgage 101 for Realtors. Okay. I will be sending out the PowerPoint and the video to anyone who is registered and pre-registered and in attendance today. If you have questions on this, give me a call. We can schedule a one-to-one and I can talk more in depth about the products and services that we have. And how it can help your buyers and sellers. Thank you very much and have a great day.